September 5, 1929. A room filled with some of the most powerful businessmen in America was listening to a 63-year-old man deliver a warning that, in hindsight, sounds almost impossible to ignore. A stock market crash was coming. Not a minor correction. Not a temporary pullback. A crash. Babson warned that sooner or later, the market would suffer what he described as a terrific decline. And the room laughed. 49 days later, the laughter was gone. By the end of October, America's stock market had entered one of the most devastating collapses in its history. Fortunes disappeared. Banks began to fail. Businesses closed. And over the years that followed, the economic damage would spread far beyond Wall Street, helping usher America into what became the Great Depression. The strange part isn't that Roger Babson was right. The strange part is that he had been warning people for years, and almost nobody wanted to hear it, because sometimes the hardest person to believe isn't the person who's wrong. It's the person who's right too early. To understand why Babson's warning mattered, you have to understand what America looked like when he delivered it. The 1920s had created something close to financial euphoria. Factories were producing more. Cars were becoming symbols of a new middle class. Radios were entering American homes. Consumer credit was expanding. And the stock market seemed to reward almost everyone who participated. The Dow Jones Industrial Average had climbed dramatically throughout the decade. Ordinary Americans were increasingly drawn into the market. And increasingly, people weren't simply buying stocks with money they already had. They were borrowing to buy them. The logic seemed almost irresistible. If stocks kept rising, the debt could be paid back with the profits. And if everyone was getting richer, why would anyone want to sit on the sidelines? Wall Street had a name for the new optimism, the new era. The implication was enormous. Maybe the old rules no longer applied. Maybe technology had changed the economy permanently. Maybe prosperity had finally become something America could sustain indefinitely. One of the country's most respected economists, Yale professor Irving Fisher, would soon become famous for declaring that stock prices had reached what he called a permanently high plateau. That sentence would age badly, but at the time it didn't sound foolish. It sounded like the consensus. And consensus is incredibly powerful when you're standing inside it. Roger Babson was standing outside it. Babson wasn't a traditional Wall Street trader. He had built his reputation around statistics, business information, and economic forecasting through the Babson Statistical Organization. While many investors were watching prices, rumors, and market sentiment, Babson was obsessed with something else: cycles. He believed economies expanded and contracted in recurring waves. Booms created excesses. Excesses eventually created reactions. And reactions created the next downturn. He described this through what he called the law of action and reaction, borrowing the language of Newtonian physics to explain economic cycles. The theory wasn't as scientifically precise as Babson sometimes made it sound. But the underlying idea was simple. A market could rise for a long time. That didn't mean it could rise forever. And Babson had started seeing signs that the 1920s boom was becoming dangerously stretched. He wasn't waiting until September 1929 to make that argument. He had been warning his clients years earlier. By the middle of the decade, he was already cautioning that the market was becoming overheated. And this created a problem. Because being early in a rising market doesn't look like wisdom. It looks like stupidity. Imagine warning someone that the party is going to end, and then watching the party continue for 3 more years. The music gets louder. The champagne keeps flowing. Everyone around you keeps getting richer. And every morning the market opens higher than it did the day before. Eventually, people stop thinking you're early. They start thinking you're crazy. That's what happened to Babson. Every month the market ignored his warnings. His credibility appeared to weaken. And every month investors who ignored him appeared to be rewarded. That is one of the most dangerous psychological traps in finance. The market can temporarily make bad decisions look brilliant. Then came September 5th. Babson was speaking at the National Business Conference in Massachusetts. He didn't tell the audience that the crash would happen on a particular date. He didn't have a crystal ball. He didn't know exactly what the catalyst would be. He made a broader argument. The market had gone too far. A reaction was coming. And when it came, it could be severe. The warning reached the news wires. And something remarkable happened. The market fell sharply that day. The decline was large enough that newspapers began referring to it as the Babson break. For a moment, the man everyone had dismissed seemed to have been vindicated. But then came the part that makes the story so psychologically important. The market recovered. Stocks bounced back. Confidence returned. And once again, the people who had ignored Babson had evidence on their side. They could point at the recovery and say, "See? He was wrong." And this is where financial bubbles become especially dangerous. Because a warning doesn't have to be completely wrong to be psychologically useless. It only has to arrive before people are ready to believe it. Babson had warned about the possibility of a major decline. The market had declined. Then it recovered. So the crowd learned the lesson it wanted to learn. Babson was another false alarm. The party continued. For several more weeks. Then October arrived. On October 24, 1929, panic selling erupted on the New York Stock Exchange. This became known as Black Thursday. Trading became chaotic. The ticker tape fell hours behind the actual market. People gathered outside the exchange, watching the financial panic unfold in real time. Then came October 29th. Black Tuesday. More than 16 million shares changed hands, an extraordinary volume for the period. The market collapsed. And this time it didn't simply bounce back. The optimism of the previous decade had begun to crack. The consequences would extend far beyond stock prices. Businesses failed. Banks collapsed. Unemployment surged. And the economic crisis that followed would become the Great Depression. But there's an uncomfortable detail hidden inside this story. The crash itself wasn't the entire Great Depression. The relationship between the 1929 crash and the Depression was far more complicated than the simple story we often tell. The crash was a major shock. But monetary policy, banking failures, falling demand, debt, deflation, and policy decisions all played roles in turning a market collapse into a prolonged economic catastrophe. History rarely gives us one villain. It gives us a chain reaction. And Roger Babson had warned about one part of that chain before most people could see it coming. Yet even after the crash, Babson's place in history remained surprisingly small. The man who had stood in front of businessmen and warned them about the danger became something close to a historical footnote. And that's where the story gets interesting. Because the real lesson isn't about predicting crashes. It's about why humans reject information they don't want to believe. Think about what Babson was asking investors to do in 1926, 1927, and 1928. He was asking them to sacrifice something. Not just money. Certainty. If you sell too early, the market can continue rising without you. Your neighbor gets richer. Your colleagues get richer. The newspaper tells you that stocks are going higher. And suddenly your decision to be cautious feels like a mistake. This is where herd behavior becomes powerful. People don't just compare their portfolios with the market. They compare themselves with other people. Being wrong alone feels terrible. Being wrong with everyone else feels strangely comfortable. And the reverse is also true. Being right alone can feel terrible when nobody else believes you. That's the psychological torture of being early. You can have the correct conclusion and still experience years of evidence that appears to prove you wrong. And this is why bubbles can survive far longer than rational analysis suggests they should. There's another psychological force at work here. Normalcy. When something has worked for a long time, our brains start treating it as permanent. The market went up yesterday. It went up last month. It went up last year. So why wouldn't it go up tomorrow? The past quietly becomes our prediction of the future. And when somebody challenges that prediction, we don't always examine the evidence. Sometimes we attack the person delivering the warning. Babson became the pessimist. The market became the optimist. And because optimism was making people money, optimism felt like intelligence. This is one of the most dangerous things about financial bubbles. They don't require everyone to be irrational. They simply require enough people to believe that the future will be slightly better than the present. Then someone else pays a little more. then someone else pays even more. And eventually the rising price itself becomes the evidence used to justify the next price. The asset isn't rising because everyone has discovered its true value. It's rising because everyone believes someone else will pay more, until eventually they don't. And that's why the most important sentence in this entire story isn't, Babson predicted the crash. It's this, being early and being wrong can look exactly the same. For years, Babson looked wrong. The market kept rising. His critics gained confidence. His followers had to live with the opportunity cost of being cautious. But when the market finally broke, the years of being early suddenly looked very different. This is why successful investing isn't simply about predicting what happens next. It's about surviving the possibility that your prediction is wrong, and surviving the possibility that you're right too early. Those are two completely different skills. A person who thinks a crash is coming and puts everything into a short position can still destroy themselves if the market keeps rising for another 3 years. But a person who recognizes that valuations are stretched, reduces unnecessary risk, keeps liquidity, avoids excessive leverage, and builds a portfolio capable of surviving different environments doesn't need to predict the exact day. They just need to avoid being destroyed when the environment changes. That's a much harder lesson, and a much more useful one. Because here's the uncomfortable truth about financial warnings. Most of them are wrong. Every generation produces people predicting the next collapse. Some are selling fear. Some are selling newsletters. Some genuinely understand the risks. And occasionally one of them is right. But if you react to every warning, you'll spend your entire life waiting for a crash that may never arrive. If you ignore every warning, eventually you'll be the person asking why nobody told you. So the goal isn't to become Roger Babson. It's not to predict the next Black Tuesday. It's to become the kind of person who doesn't need perfect predictions to survive imperfect markets. That's the difference between forecasting and preparation. Forecasting asks, what happens next? Preparation asks, what happens to me if I'm wrong? The second question is far more useful. And this brings us back to that room in September 1929. A group of powerful businessmen, a 63-year-old statistician, one uncomfortable warning, and laughter. They weren't necessarily stupid. They weren't necessarily greedy. They were human. They had watched the economy expand. They had watched stocks rise. They had seen previous warnings fail. And they had every reason, based on the information they had experienced, to believe the good times could continue. That's what makes bubbles so dangerous. The people inside them don't feel like they're living through history. They feel like they're living through normal life, until normal stops being normal. Today, the technology is different. The companies are different. The financial instruments are different. The language is different. But the psychology hasn't changed nearly as much as we like to believe. Every generation eventually discovers a reason why the old rules no longer apply. A new technology, a new asset, a new monetary environment, a new economic theory, a new era, and maybe sometimes the world really has changed. That's the difficult part. You can't simply assume every boom is a bubble. You can't assume every warning is wisdom. And you can't build wealth by permanently expecting disaster. But you can remember one thing. A rising market is not proof that risk has disappeared. Sometimes it's simply proof that people have become comfortable with it. Roger Babson didn't know the exact day the market would collapse. He didn't know how deep the depression would become. He didn't know which companies would survive. What he understood was something much simpler. The pendulum doesn't stop swinging just because everyone is enjoying the direction it's moving. It swings from optimism to pessimism, from confidence to fear, from boom to bust, and eventually back again. That's the part of Babson's story that still matters almost a century later. Not that he predicted one crash, but that he understood something about human beings. We rarely reject a warning because the evidence is impossible. We reject it because accepting it would require us to change what we're already doing. And sometimes, the room laughs, until it doesn't. If you want to understand money beyond the charts, the headlines, and the hype, subscribe to Money Elevate. Because history doesn't repeat the same dates. It repeats the same psychology. And the next time the room starts laughing at a warning, you might want to understand why.